Welcome to your fast track guide to financial literacy. This summary covers the essential foundations of personal finance, from budgeting and saving to investing and understanding loans. By the end, you'll have a clear framework for managing your money. Let's start with the foundation: budgeting. A budget is simply a plan for your money, showing what comes in and what goes out. A popular and effective method is the 50-30-20 rule. This means allocating 50% of your after-tax income to needs like rent and groceries, 30% to wants like dining out, and the final 20% to savings. This savings portion is crucial for building an emergency fund, which should cover 3 to 6 months of living expenses in case of job loss or unexpected events. Once you have your budget, you can start setting financial goals using the SMART framework. Your goals should be specific, measurable, achievable, realistic, and time bound. For example, instead of saying I want to be rich, a SMART goal is I want to save $20,000 for a down payment on a house in 4 years. To track your overall progress, calculate your net worth, simply subtract your liabilities, like loans, from your assets, like savings and property. This gives you a clear picture of your financial health. Now let's talk about credit. Your credit score is a measure of how likely you are to repay debt. A good score helps you get better interest rates on loans. To build good credit, focus on 2 key areas. First, pay your bills on time. This is the most important factor. Second, maintain a low credit utilization ratio. This means if you have a credit card with a $10,000 limit, try to spend only a small fraction of it each month. Credit cards are a double-edged sword. They build credit and offer rewards, but if you don't pay the balance in full each month, you'll face extremely high interest rates that can lead to a dangerous debt cycle. This brings us to loans and debt. Not all debt is bad. Good debt is an investment in your future, like a student loan or a mortgage for a home that will likely increase in value. Bad debt is when you borrow for things that lose value or you can't afford, like high interest credit card debt for unnecessary purchases. If you do have debt, prioritize paying it off. 2 common strategies are the high rate approach, where you pay off the highest interest debt first, and the snowball method, where you pay off the smallest debt first for psychological motivation. We also need to talk about insurance. Insurance is how you transfer financial risk. It protects you from catastrophic loss. Key terms to understand are the premium, which is your monthly payment, the deductible, which is what you pay out of pocket before insurance kicks in, and the policy limit, which is the maximum the insurer will pay. The goal is to manage risk, not to make money from insurance. It's a safety net for when things go wrong. Now, for the most powerful concept in finance, investing, this is where you put your money to work for you. The earlier you start, the better, thanks to the magic of compound interest. Compound interest is when you earn returns not only on your initial investment, but also on the accumulated returns over time. This is why starting to invest even small amounts early can outperform starting larger amounts later. There's a direct relationship between risk and reward. Low risk options like savings accounts or government bonds offer low returns. For long-term goals like retirement, you'll want to consider moderate risk, moderate return investments like index funds that track the entire stock market. The key is to diversify. Don't put all your money in one place. Spread it across different types of investments to manage your overall risk. Remember, before you dive into investing, make sure you have your budget in place, an emergency fund saved, and no high interest debt. When it comes to taxes, understand that you pay them in many ways, not just during tax season. Sales tax, property tax, and income tax are all common. For most employees, taxes are automatically deducted from your paycheck. If you're self-employed, you are responsible for calculating and paying them yourself. Be aware of tax-deductible expenses and tax credits, which can lower your tax bill. Finally, for big decisions like buying a house, you need to do a careful analysis. The decision to rent or buy isn't just about the monthly payment. You have to consider property taxes, maintenance costs, and the fact that your mortgage interest might be tax deductible. You also need to consider the opportunity cost. If you use your savings for a down payment, that money isn't invested elsewhere. Run the numbers for your specific situation. In conclusion, financial literacy is a journey. Start by building a budget, establishing an emergency fund, and setting smart goals. Understand how credit works, use it responsibly, and distinguish between good and bad debt. Protect your assets with insurance, and then begin investing early to take advantage of compound interest. Remember, the best investment you can make is in your own financial knowledge. By mastering these foundations, you're building a secure and prosperous future. That's all I got for you today. Don't forget to drop a like.